Hey, it's KP coming to you live from Corona, California. Welcome to another episode of KP Talks. And of course, for those on your home network, also for Financial Freedom with KP. So we got a little news recap. We're gonna go over some of the big data that came out this past week. The CPI report was the biggest one. Inflation has peaked. Mortgage interest rates have peaked. Everyone's talking about it now, but we already have been discovering that here on this channel over the last couple months. So we'll talk about that outstanding consensus and what it means for you as we kick off spring purchase season for the housing industry. All right, so let's get cracking. Inflation is the fight. This is the fight that the Fed is in. Fed has been raising interest rates. They've been going up basically since March of last year. 25, then 50 basis point rate hike. A bunch of subsequent 75 basis point rate hikes. The last rate hike they made was only 50 basis points, telling the market that we are closer to the end of the rate hikes, the tightening cycle of the Fed. This last reading that came out came down year over year and month over month. Inflation is coming down. Now, it's still 6.5%, but it's still a high number. It's still higher than the Fed funds rate, which is at 4.25% to 4.5%. So the debate is, how high is the Fed going to go for their terminal rate, the final rate that they'll be at? They've been saying, remember we talked about the dot plot on here, all the Fed speakers, how they go out and they're speaking, and they have been speaking. And they've been saying consensus terminal rate is gonna be above 5%. Well, that means we're gonna need at least another 50 basis points in a rate hike. Now, the consensus, remember we talk about the CME tool, about 80% of these Fed fund futures bets, if you will, are saying that there's only gonna be a 25 basis point rate hike at the next February 1st meeting. And then another 25 basis points at the March 22nd meeting, which is the next Fed meeting after that. And the market also thinks, it's a stock market, that there's gonna be rate cuts later in the last part of the year, Q3, Q4 of 2023. They will have fought and battled inflation and beat inflation. They don't wanna keep interest rates too high too long. If they do, they might break something. You and I both know as interest rates go up, things that are very sensitive to mortgage interest rates like car loans, credit card loans, mortgages, it hurts us. It makes me not want to pay for a new house, buy a new car, thanks in part mostly to the Fed. As we get closer to the end of the Fed rate hike and tightening cycle, you will start to see the markets adjust. One of those adjustments is the mortgage interest rates have peaked. Since November 10th, which was a CPI inflation report that came in lower than expected, mortgage interest rates have been coming down since that peak. They were well over 7% on the average 30-year fixed. We're hovering just above 6% right now. That's a full percentage point in just a few months. These things can move very quickly. The Fed may be raising rates, but mortgage interest rates are coming down. That's a very important point when you get across. They're not completely connected. We have a producer price index report coming out this week. By the time this video makes it out there, the data will probably be live. This is the cost of inputs for goods to be produced. How much do producers pay? Remember how expensive everything got? Lumber for housing, labor, copper. The cost of copper is a very good barometer of how the economy is doing. It's kind of a future barometer of, are costs coming down for the components that go into making things? So again, we've seen peak inflation. If you just took the last CPI reports, the last three, so you got the October data, the November data, and then now recently the December data, we're at 1.8% inflation. Now, of course, those numbers, the CPI reports, are based on the last 12 months. But if you just look at the last three, we're below the Fed's mandate of 2% inflation. So that's why the market is looking ahead. When you have data like that that's coming down, you and I both see that rent on new leases are down. The cost to rent a home has come down. Mortgage interest rates have come down in just 2 months, a full percentage point. We see that on new information, new mortgages, new rentals, new everything. So I think between now and May, which is when you get a lot more data coming out, remember, each of these data points are an index. So every time we have a new report, the oldest month gets replaced with new data. And there's some really big numbers being replaced from March, April, and May of last year of 2022. So when those start to get replaced by smaller numbers that we're experiencing now, you'll see these headline numbers come down further and further. It's still uncertain how long it will take to really stamp it out. And what will the repercussion be of higher interest rates? Our economy is based on consumer demand. About 70% of our economy is based on consumer demand, the GDP. They are using credit cards more, which is not healthy, but they're still spending. And the cost of what they're spending on generally is coming down. So right now, we're in that little zone. Are we gonna be facing a recession? Are we gonna be facing a mild recession? Or are we gonna face no recession and have the Fed engineer what we've been talking about is called a soft landing? We don't know, we're gonna find out. I'm in between mild recession to mildly soft landing camp. That's where I think we're at. Not Goldilocks, but it ain't that bad, right? Peak inflation, peak mortgage interest rates. Let's talk about that. It is spring purchase season. It is kicked off. We are more than halfway through January, and borrowers are out on the hunt. They got a new school year coming up, the summer's coming up, and again, mortgage interest rates have come down. Now, nothing comes up and down in a straight line, but the trend has been for lower mortgage interest rates. So we've seen the peak in interest rates. Get out in front of all of your competing borrowers. It's a seasonal trend every single year that the spring purchase season is where more people come out of the woodworks and they go look for homes. So if you're in the market, think about these things. Peak inflation, peak interest rates, they've been trending down, and it's a great time to buy and get out in front of the crowd. All right, bull market, bear market rallies. What are these things? Generally, stock markets have been in a bull market. They spend a lot of their time being in what's called a bull market, which means that there's growth, there's overall growth. The S&P 500 is a standard at which the return of the stock market is measured. The return last year of the 60/40 portfolio using the S&P 500 was a 14% loss. But if you were only in the stock market, the S&P 500 lost 19% last year. It was worse in the year, but you start to see a little bit of a comeback since November. So at one point, it was worse. So you've got different market indices that you use. S&P 500, the Dow Jones Industrial Average, the NASDAQ component. If any of these indices that measures the markets, if they go down 20% or more, that's technically a bear market, which we saw last year. We saw a bear market. Bear markets are tough. A rate hike tightening cycle from the Fed. There's less liquidity, there's less money. The cost of credit's more expensive. Interest rates of everything goes up, and it erodes our buying power. So people were conserving their cash and not spending as much. And with less of it out there to invest, you see a contraction in the market. That's a bear market. But generally, the markets are in a bull market. And generally, S&P over any 30, 50, or 100-year period returns about 11%. Anywhere from 8 to 11%, depending on which indice you use, S&P 500, NASDAQ, Dow Jones Industrial Average. So you've got these different asset classes that when they're growing and they're returning money at a good, consistent clip, you're in a bull market. Now, the lasting effect of all that reflation, all that liquidity that they injected into the market, we had this nice bull market run in the stock markets, fueled by a lot of cheap money. We have a lot of people out there who have mortgage interest rates at 2.5%, but most people are really locked into that cheap money on their mortgages because the Fed injected so much liquidity into the system. Well, in this bear market, there's actually a shrinking of money supply. And there's less money, less credit, higher interest rates. So there's less transactions. The economy isn't growing. Is it contracting so much that we're in a recession? We don't know. And there's this economic bureau and review board that looks at the data like a year later, and they go back and go, yeah, we were in a recession, Q1, Q2, Q3 of 2022. They tell us later, but we all kind of know how it feels when things are good versus bad versus contracting versus growing. There are rallies within bear markets. Some people call it a bull trap. People get excited. They see the stocks are going up like they have been the first part of January of 2023. And then, of course, earnings reports continue to come out. The banks kicked off earnings last week. It was kind of a mixed bag. Some banks did well, some not as well as others, but most of them are reserving money in loan loss reserves in case there is a recession. in case borrowers default on their car loans, in case they default on their credit card loans with the banks or their mortgages, because they might lose their job. Fortunately, the job market has held up really good. People haven't been losing their jobs en masse. In the last unemployment report, the December jobs report that came out the first Friday of January, had the unemployment rate go down to 3.5%. There's still 10.4 million jobs open in the job opening labor turnover report, the JOLTS report, which you can look that up. So the job market, employment market is still very healthy, and that's really helped potentially engineer a soft landing. It's another reason why the stock market seems to be doing okay and rallying the first part of this year. So what is a bear market rally? The trend for the market has been to go down. We've watched stocks go down 19% last year. So if you pop up and have a little rally where things get positive, but you're still within a major downtrend, that's what's known as a bear market rally. You're rallying up temporarily while the entire market is still trending downward. We don't know if we're out of the bear market yet. We're not gonna know. We don't have the data. I am not here to tell you that this is a bear market rally that we're currently in and we're gonna continue to trend downward. But we're watching data come out all the time, and that helps us define how we invest. So let's talk about investing. Investing versus trading. It's a big, big difference. Investing is long-term. Maybe you have enough money and you're retired and you are ready to not lose your money. This risk reward, stocks versus bonds, investing long-term versus trading at different durations, like maybe swing trading, a couple weeks, a couple months, or day trading, which some people stare at screens all day and look at the ticks on the markets and try and make educated guesses. You have to define what you want to do with your money. One of the things that I do is I try and say, if this is something that's my conservative investing, okay, knowing that we're getting closer to the end of the Fed rate hike cycle, but we may be getting closer to a recession, that might contract my investing dollars, that might make me lose it. Now remember, until you sell something at a loss and realize a loss, or sell it at a profit and realize the gain, it's still just paper money, loss or gain, which is why it's important to define your investment horizon. If stocks go down and you are fully confident that, like Apple, for example, is a long-term bet, who cares if it goes down? If you're not selling and locking in a loss and you're investing in the long term, like a Warren Buffett, this is just part of the roller coaster. Do yourself a favor. If you're investing, you don't need to look at it and get yourself emotionally worked up, because generally over time, 3 to 5 years out, great companies like Apple do a good job. Now, I'm not a financial advisor. I'm not responsible for your losses, only your profits. But if you need serious advice and you want to have a financial advisor manage your money, go find one. We have a whole network of financial advisors that are tied to this channel. So they can help you invest your money for the long term. That's investing. Trading, totally different animal. Now, when I get into trading, I start to think of it as higher risk, higher reward. If I got $100 and I want to put 10% to risk making more money, you say, you know what? I think Tesla's gotten beaten down way too much. Tesla stock should be doing so much better. They are the leader in EVs in America, and their cash position is huge. They have all these factories built. I'm a bull. I am getting behind Tesla. I don't like how low it's gotten. I'm going to invest in it. As long as you know the other side of that argument is they've had their heyday. The competition is fierce. You know, Volkswagen's already the #1 EV seller in Europe. There's great competition coming from Ford and other large legacy manufactured auto manufacturers. We're going into a recession, so people aren't going to pay for an electric vehicle en masse, and the orders are going to come down. And I don't really care that Tesla's #1 in America. So I still think there's room for it to go down. If you believe that about Tesla, maybe you don't want to put your money in risk, that 10% trading. You don't want to risk that. Maybe you want to put it somewhere else. You could say, you know what? This company has gone down 90% year to date. There's no way it could go down anymore. So I'm going to take that $10 trading risk and I'm going to buy Meta. I got good news and bad news for you. The bad news is, hey, it could go down another 50% from where it's at. Or you could say, you know what, I think we're not gonna have a recession, and I think advertising dollars are gonna come back in, and I really love the platform at Meta, Facebook. They do a great job. You're welcome to make these decisions, but just know that when you shorten your trade horizon, investing versus trading, you are raising and increasing your risk. And that's something you need to understand and be comfortable with losing. The whole point of all these videos is to try and look at the data that other professional money managers are looking at. What are they seeing? What are they looking at? What's the big macro data that gives a headwind that makes it harder to move forward, or a tailwind, which makes it a little bit easier to run up that trail? What is it that the macro factors are doing for you and your money as we both try and discover and attain more financial freedom as we invest, potentially trade, buy a home? I hope this video was helpful for you. We'll get another one coming out here in just a couple weeks. Thank you. Cheers.